Has the path of this bull market taken a turn for the worse? Let's ask BlackRock's CIO of Global Fixed Income, Rick Rieder. He joins me now at Post 9. It's good to see you again, man.
Yeah, thanks for having me.
So let's talk about this backup in rates. I just want to know sort of what you think about it as you're sitting here like we all are, watching it and trying to figure out what it means.
So, I mean, the first thing you say, that employment number on Friday was pretty powerful. And it led to this belief and when you look at the confluence of data that's come out, you get an economy that's operating at a pretty strong level. We've talked about a bunch of times on your show. People want to continue to talk about, well, this is it, the economy's bending down, we've got pressure in different parts of it. And if you look at how the service sector did, again, in hiring, and you look at services generally in the economy, they're doing well. So, you get asked all the time, like, where do you start buying rates here? And I find long-end interest rates still not that interesting. I mean, there is a point that you start adding as you get to around 5% on the 10-year. Maybe you add a little bit. But you got an economy that's operating pretty well, and you've got uncertainty around where inflation is. I mean, the Fed, we're going to get CPI, PPI this week. You're still operating year-on-year core CPI at 3+%, and core PCE we think is going to run mid to high 2s for most of the year. Fed's still, in a tough spot. Unless employment starts to soften, you've got rates that aren't going to come down from here of any significant magnitude.
All right, so you make the case, it sounds like, first and foremost, that rates are going up for the quote-unquote right reason.
Yep.
Right? You tweeted it earlier today
Yep.
about an economy, in your words, as you just said, is in very healthy shape. So why is the stock market then having a problem with rates if it's for the right reason?
So I think there's a near-term dynamic, and I think there's an intermediate-term dynamic. So, every time people say, remember it was like if the 10-year gets to 3.75, it's over, 4%. It takes a little bit of digestion. I know we've said it before, this economy is much less interest rate sensitive than ever before, and you look at things like the mag savvy, look at the big tech stocks, they don't borrow. In fact, they're net long cash. So, but you need to digest this rate dynamic. My sense is we'll go through this period, rates will stabilize around these levels. I still think the trend is, particularly in long rates, is to move a bit higher still.
Higher than here?
Yeah. So, yeah.
I mean, the 30-year is basically 5%, right? We're at, what, 480 on the 10?
Yeah.
Are you saying that the 10-year is going to go over 5?
So first of all, I think the momentum of the 10-year is to move higher than that. Second of all, there isn't a lot of rationale for buying 10-year treasuries today. You get so much yield in the front end of the yield curve. We talked about it on your show for a while. If you think about how 2024 finished, if you're sitting in the front end, you had significantly positive return. The 1 to 3 year part of the index was plus 4%. The back end was negative 4%. What's changed? You still have a relatively flat yield curve. You've got term premiums not enough out the yield curve. So I still think you could have, and you've got a lot of issuance that's going to come. So I still think you could move higher in interest rate. Listen, I think once you get to 5, it is, whether it's optically a ceiling or not, there is some buying that will come in. So I don't think we're going much higher, but listen, I think the gravitation is you still move higher around an economy that's in good shape, and a Fed that can't really go until you get a couple of months of softness in the labor numbers.
So you don't think that the move higher in yields has made bonds attractive enough to be serious competition for stocks? I mean, because that's one of the conversations that's being had now. It's like, well, what was thought to be a really equity-rich environment, well, now you have competition again from bonds and cash.
So it's a question of what bonds. So to me, and I've said this before, like, people don't realize you can create, and we run portfolios with 2-year duration, a very short interest rate exposure, where you're clipping 6.5% yield. Those bonds I love. And by the way, you don't have to stretch in terms of credit quality. Those are great. So you think about what longer bonds are, and if you said, I've got 2 assets I can hold that have long duration, I can own equities or I can own bonds. Bonds, even at 5%, I'm thinking, like, what is my upside downside? So you think about mega cap, they're throwing a 30% return on equity. If I'm going to hold those for 2 years, 3 years, 5 years, and they buy back a huge amount of their stock, so they shrink the denominator, their book equity, so I can own that and compound 30% plus, even with multiples that are not cheap. Or I can own long treasuries. Like, I think what bonds are today is you own shorter term bonds, you clip a bunch of income, marry that to equity, and I still think tech stocks, growth equity makes a ton of sense. So I think the 10-year note's an alternative to buying mega cap? No, I don't think so.
I mean, you already had an problem, if you want to go that far, with valuation, to some degree, right? I mean, you said it on this program numerous times.
Yeah.
It made you a little uncomfortable where equity valuations had gone.
Yeah.
Did it make you even more uncomfortable where rates are relative to valuation? Now isn't it even more of a problem?
So So I would say, we've shifted our exposure a fair amount. So remember, being on your show, we talked about buying call options on equities, and you could run a long equity position. And you think about when volatility for much of the year was so low, you could buy call options at 9, 10 volatility. So you could run a long position with upside convexity. Now, with multiples where they are, I would argue beginning of the year, there's some tax selling, there's some pressure that you could have volatility around rates, oil prices, et cetera. I think so we still like being moderately long equities, but now you could buy down, but now we are moved it much more to buying downside convexity, buying put spreads against positions, buying some downside. So you look at days like Friday, your put options kick in. So it's a different expression that we were running for much of last year.
But you're looking to be a little more hedged than now than you were then.
Yeah, so a different type of hedge and upside, whereas before we were long, but we were long and we were convex to the upside because we were long calls. Very different expression today. We're still moderately long, and I still think if you look at tech and the return on equity, the stock buyback, and the amount of cash that's out there, pretty hard to see the equity market not finding its footing and having a decent year, not like last year.